Welcome everybody to Netcapital's live Q&A with Defynance. We've got with us today the CEO of Defynance. He's going to talk us through the company and dig through some questions with us. Thanks again for everyone who's watching live and of course everyone who's watching via recording. If anyone has questions as we go through this webinar, please feel free to use the Q&A function here in the Zoom chat, and we'll ask those questions as appropriate. And for anyone watching this as a recording, there will be a link to Defynance's offering page on Netcapital. And on that page, there's a discussion board. So if this webinar raises any questions for you, you can always ask a question there. So with that, we have Farrukh with us. Thanks for joining us.
Thank you, Rob, for hosting this. And we love questions, by the way, so keep asking. It's awesome.
Yeah, we're looking forward to diving in. So, just right off the bat to set the stage, can you just give us a brief description of Defynance? Kind of what are you guys?
Yeah, I mean, just very briefly, I would call us a social impact fintech. We're tackling a financial problem. But we want to do it in a responsible way and build a solution that provides a lot of social impact to a lot of people. And we started in 2018. The company started in Tampa, Florida, but we've recently located to Atlanta, Georgia. So we've come up north a little bit, closer to you guys, Boston. And yeah, we're very well supported by like the ATDC, which is a major incubator out of Atlanta, backed by Georgia Tech University, WeWork Labs, the Embark Collective. So we're really focused on really building a movement around socially responsible finance, and that's why crowdfunding and kind of being on the Netcapital platform is so awesome for us, because it really allows us to tell the story to a lot of people.
That's fantastic. And of course, that resonates with Netcapital because our goal is to democratize access to these early stage companies and help founders raise capital. So it's exciting to be working together.
Awesome. Yeah, I think I'm seeing some of those trends now. So just yesterday, I just saw an article on LinkedIn about somebody creating a VC fund for non-accredited investors. So I was like, wow, there's something else that's new that's coming that's kind of cool.
It is a brave new world for startups, for investors, for founders. Lots of really cool stuff going on.
Absolutely.
So before we dive in, I'm really excited to talk about the product. Before we dive in there, would love to learn a little bit more about you and the rest of the team. Kind of what are your backgrounds? How did you guys get together to create the product?
Yeah. I've been in financial services for a long time. I don't no longer like to think about how long, because it's been way too long. But and then I've also spent a few years during the dot-com days in the mid to late 90s as a technology developer, web application developer. So a lot of background in financial services, credit underwriting, insurance, risk mitigation. That's sort of been my career journey. I've been a founder previously, starting in 2005, built out a commercial real estate mortgage platform with a couple other partners. We partnered up with Deutsche Bank for liquidity. We partnered up with Pacific Life Insurance to service our assets. Unfortunately, our timing was horrible. It took us 2 years to build the whole thing, and we came to market in 2007 spring, built up a deal pipeline of about $500 million very quickly, but then the financial services crisis started. So as you know, a lot of people suffered a lot during those days. So our business model basically crashed. And since then, I've had another small endeavor on like a small insurance brokerage focusing on like a mutual insurance for homeowners insurance, working with Lexington Insurance Company. And then in 2018, I really thought about, okay, what is the next big problem to solve? And I started putting our initial team together. So, Sean came on board, Akash came on board, and we started looking at a couple of things, but the student debt crisis just screamed out to us. So we and I'll talk more about that as we go on, but that really stood out as a huge problem. And we started working on it, doing our R&D and so on. And then we've also recruited some more people along the way. There's Zen is on our team. He's like our crack research analyst. And then early this year, we started building out our business development marketing team in preparation to coming to market as we are now. So we have Michael, Shanice, Ibrahim. These guys are our core marketing team, and hopefully I'm hearing some good stuff about what we're doing on social media and everything. So So I think everybody's kind of growing up and learning together and really contributing great things along the way.
That's awesome. It's fun to watch a team come together for sure.
Yeah, absolutely. I mean, our problem is a problem for this, sort of the Gen Z millennial generation, the student debt crisis. So having these types of folks on the team who are really passionate about, solving this problem and something that really resonates with them as well goes a long way, to create that energy and that passion that's so necessary in a startup.
Yeah, and that's a perfect segue to my next question, which is, let's talk about the problem. So, what are the problem that you guys have identified that you're trying to tackle? And let's dig into the details there.
Yeah, I mean, the student debt crisis, the numbers are scary. Like 44, 45 million people now have student loans. It's growing at 10%, annually. 70% of people leave, leave school, right, with student debt. So that's, the bulk of the people. And to me, that what it really tells me is that it really is a middle class, problem, because if you're not as well financially, you have scholarships, grants, other resources that you can tap into. And if you have the money, then you could, pay for college. So really the people that are making good money, but too much money to really afford college. That's sort of the dilemma of the middle class, not only in this area, but in many areas, in our economy. But so I think that's one of the biggest things. And what really stood out to me was it's like now the second largest consumer debt after mortgages, but more than credit cards, more than auto loans. I'd never imagined that student debt would grow to this extent, but that's really what's developed over the years.
And if I remember right, student debt is also not forgivable in bankruptcy. Is that correct?
Yeah, that's correct. I mean, technically, I guess, some lawyers will argue that you can pursue it, but yeah, functionally, it's really not forgivable. And people are really stuck with this forever. And as we talk about our product more, I'll kind of highlight some of the ways how people just get stuck with student debt, literally for years and years, much more than they ever imagined.
Yeah, well, and that's a great segue. Why don't we dive in? Kind of tell us what is Defynance? Tell us about the product.
Great. So one of the things, like I mentioned in the beginning, sort of social impact or socially responsible finance. And one of the things for me that sticks out is debt. Debt is, is sort of the foundation of our, within our economy. And I'm, very much against debt. And I really think it hurts a lot of people. And what really bothers me the most about it is that it hurts you when you're not doing well. So when you need help and support, that's where debt really becomes a big issue. So for example, let's talk about student debt specifically. So you have student debt, you're working, then you lose your job because sometimes it's no fault of your own, like the COVID crisis, pandemic starts and people lose jobs. And now what happens? Now all of a sudden, and the government has frozen student loans, but there are private loans, other loans that are still, this is applicable to. People, if you're not able to make a payment, what would a lender do, right? They would charge late fees. They would report that to credit. Interest would accumulate and the balance would grow. So the problem just keeps compounding at a time when you need help and support the most. And with Defynance, what we're doing is we're saying, we're not going to use a debt-based financing structure. We're going to use an income share agreement, which is a debt-free financing mechanism. So we actually would pay off someone's student loans, get them out of debt, get that removed from their credit, and convert them to an income share agreement where they agree to share a small percentage of their income for a set period of time. So it's a function of time, not about an amount that has to be paid back with interest. And so during that time, what they eventually end up paying is somewhat unknown because we don't know exactly what's going to happen in the future. But the important thing for the consumer is that their payment is linked to their income. So as their income goes up and down, the payment adjusts automatically. So if the situation is getting worse for some reason, like for example, during COVID, you're getting a salary cut, going on furlough, losing your job. In those scenarios, your payments would actually pause with us because if income drops below 25,000, we would pause your payments. And we would do the exact opposite. We would actually help you find a job. So we've curated a resources marketplace with career counselors, job boards, recruiters, upskill resources. And even further, we've said, okay, look, even if you're dealing with these issues, you're having, depression, anxiety, mental health concerns. So we have mental health counselors that are there to support you. So to make sure that that doesn't impact your job performance. Credit resources so that you have good credit histories, so you're able to get the best jobs, because big companies look for credit histories as one of their background checks, and other things in the marketplace too that go beyond the career. So we're actually helping people, and what I love about the income share agreement solution is the goals are always the same. The more they do better, meaning our customer does better, the more money we make. And whenever they're struggling, obviously we're not getting paid, so we're incentivized to help them get out of their situation. And finally, we create liquidity by getting investors to pool money in our fund, and we use that capital to fund these refinancing transactions. And as our customers are making their income share payments, we distribute those to investors quarterly, so it becomes a passive income, fixed income investment, kind of like fixed income, but returns are closer to equities, because we're forecasting returns at about a 7 to 10% range with low volatility. So that's sort of comprehensively what the product is all about.
That's great. And you answered some of my follow-ups, but I want to dive in a little bit. So
sure.
If I'm a student and I have debt, how do I get onto the Defynance platform?
Yeah, you just go to our website, and that's what we did this year. We built out our online platform, our MVP. So just fair warning, it may not be the prettiest looking product today. However, it's functional, it works, but we are working on making it look a lot better by early next year. And that's why we're raising capital, right? Because we need resources to continue building further. But anyway, you go to the website, there's an apply button. You can apply and create an account in our platform. And then you can apply for the income share agreement. We would then go through the process of giving you a quote. And then give you multiple options. For 5 years of income sharing, your income share percentage would be X. And for 10 years, it would be Y. And then you can decide whichever one makes sense for you. And then once you decide that, then we just go through the process of getting you approved. So we need to verify your income, look at your payoffs on your student loans, and a few other things that need to be done. And once the approval is done and you accept the approval, then we proceed on to funding. And then once we fund, that means we pay off your existing student loans, convert you to an income share agreement, and then you start making your income share payments from there on out.
And so during that kind of due diligence process on the potential would you call them borrowers? Do you call them, what do you call them?
Customers.
Customers, fair enough.
Yeah.
When you're talking to these potential customers, what are the things you look for? Do you just look at their credit history and how much debt they have? Do you look at what jobs they have, what kind of degrees they have? What do you look at there?
Yeah, Rob, essentially, we're not lending money, we're investing in people's earning potential, right? So for us, it's important to do a proper due diligence on their earning potential. So yes, we would look at their job, look back a little bit in terms of their work history, where have they worked the last few years? How has their income progressed in that time period? We would also look at their academic background. This is especially true for people that are more fresh out of college, but we have applicants who are in their 30s and 40s even, who've been working for a while, because student debt stays with you for a long time. So we're getting all kinds of people that are applying. And then credit is interesting, because credit is not, or the way credit scores are calculated, it's not a good indicator for a younger person, right? Because credit weighting, the way it's done, there's a heavy emphasis on utilization and amount of credit and so on, where younger people just haven't had the time to really build those credit resources. So we don't score somebody or make a decision based on a credit score. We do track it because we want to see how our own underwriting assessments compare, but we don't make a decision on a credit score. But we do look at factors, like we want to make sure you don't have a bunch of late payments, or you don't have like bankruptcy or other derogatory items. We kind of factor those in, but we don't just look at the credit score and make a decision.
Yeah, that makes sense. I imagine that could be misleading if that was what you used first and foremost. So give us a sense of if I were to sign up for one of these ISAs, what percentage of my income might I expect to pay back? What are the ranges?
Sure. So one other point I just want to add is that we also don't need a cosigner, because we validate someone's income and we really verify their job and what their income potential is. We don't necessarily need to rely on a cosigner, which actually opens it up to some people who are not able to qualify for student loans or even refinancing of student loans because they don't have a good cosigner. But as to your question, if we kind of look at the average student debt, which is about in the low 30,000s when you come out of college, and let's assume that someone fresh out of college and maybe a little bit of work experience has about a 45,000 salary. So if that person comes to us, then for a 10-year income share agreement, roughly, and I'm just giving you a base pricing because it adjusts with risk also, because somebody could be less than this or more even. It would be about 9.5% of their income shared for 10 years. So that's what we work out for that candidate. But if somebody has more debt, but a lot more income, the income percentage would go down because they have a lot more income. So we do that the ratio between debt and income is an important factor for us to consider, because we don't want to burden them with a very high income share percentage, where then it's difficult for them to pay for rent or mortgage and other liabilities and other just life essentially, right, in terms of dealing with life. So we want to kind of cap the income share percentage as much as possible at like 15% or less, but I think in most cases it'll be 10% or less in terms of how we're going to do it. But yeah, that's an important criteria for us also. We do look at that debt to income perspective.
Of course. And then this might seem counterintuitive, but are there any provisions that might allow someone to buy themselves out of the contract?
Yes.
If they get a big raise or something and they decide it's better just to buy it out?
For sure. I mean, on the downside, the product itself has these inherent protections. But on the upside, there's a risk, because if you do very well, you may end up paying more money. So we do account for that risk in many ways. One thing we have is a payment cap that scales with time. So it starts at 1.1 of the funding amount in year one and goes up by 0.1 every year. So let's say you after 2 years, you just become the CEO of your company, your salary goes from $45,000 to $1 million. You could probably hit the payment cap within a few months and you're done. You're out of the contract. We also have a prepayment mechanism where we tell everybody, all of our customers, a certain dollar amount every year. Once they hit that dollar amount of extra payments above and beyond their normal income share payment, then 1 month is reduced. So they can do that as fast as possible, or they can do it slowly. So that's completely up to them, full flexibility. But yet it's theoretically possible to take a 10-year income share agreement and start reducing it and finish it in 7 years, 8 years, whatever the case may be. We also have buyout provisions. And then finally, we have another interesting concept for what we call self-equity, where we require everyone to buy back 5% of their income share agreement right at the beginning before it even starts. Meaning, let's say they do a 10-year, and we give them anywhere from 1 month to even 3-4 months to buy it back. Once they do that, then they own 5% of their own income share agreement. So every payment that they make, 5% goes into their self-equity account. And at the end, we give all of that back to them as like a savings. So the better they do, the more money goes in there, right? Because their salary is going up, 5% of their income, whatever the income share percentage is, 5% is going there. And they can even buy more than 5%, but 5% is a minimum. They can take, some people may decide to do 10% or whatever. So they kind of become an investor in their own income share agreement deal, which also protects our investors, because it shows them this person believes in themselves. They're putting some skin in the game, so to speak, right? And mitigates the investor risk. And if for some rare reason someone defaults, then that money is forfeited and back to our fund. So there's a little bit of a protection for the investor too. So yeah, these are various mechanisms where we have figured out how we can reduce the net cost of the income share agreement.
That makes sense. And so from this might be getting too into the weeds, but from your perspective, or for your customers, if they, on average, would you expect them to pay similar to what they owe? If things go well, I assume they're going to pay a little bit more than they might have with debt, but with downside protection. Are you expecting everyone to pay just about what they would have on their loans, just in a different way?
We expect it to be competitive. It could be a little bit more, but they're getting a lot more for it too. They're getting a lot of protection as well that comes with this type of a structure. Even if they do well, the self-equity account will give them a lump sum cash back at the end, which reduces the net cost as well.
Sure.
So we certainly want it to be competitive. It has to be competitive. Otherwise, why would somebody do it, right? I mean, there has to be a Price is an important factor, but when we make our purchase decisions in life, right? Price is one factor, but we look at many other factors too. With the financial product, I think people should look at the downside risk of a financial product and make sure that they're protecting themselves against the downside risk, because as good as you are, as well as you may be trained from an educational perspective, or you don't always control what may happen with your job, right? Because great companies shut down. It happens all the time. People lose their jobs. Financial crisis happens. So I think this part of it, where I think college students typically, they get essentially free money in college. You don't have to qualify for a student loan. You get a student loan. So maybe you don't think about what happens in the future. Am I really stuck with something that's going to cause me problems? And I think hopefully one of the things I want to emphasize as we're kind of getting this message out is for people to become more responsible in terms of how they think about, financing student debt, but also generally financing overall, because I think it's important for consumers to become a lot more cognizant. I think the ISA essentially offers like downside insurance. It protects you to make sure that you don't really get harmed if something bad happens in your life.
That makes sense. And switching to the kind of the refinancing payment. So when Defynance pays off someone's student loan, how are you guys? Talk to me a little bit more about how the company is financing those purchases or those transactions.
Yeah, so the other component of our platform is what we're calling the ISA refinancing fund, which we launched last week at SOCAP. We were one of the scholarship entrepreneurs at SOCAP, which is the leading social capital, social impact conference in the country. So we launched that last week. So in the beginning, it'll be for accredited investors and impact investors who will invest in that fund. And then we will use that capital to refinance student loans. And once we refinance that student loan and people start making their income share payments, that income stream goes back into the fund. And it's not just going to be one, it's going to be hopefully hundreds and thousands of income share agreements or monthly payments are coming back into the fund. And depending on how much shares each investor has in the fund, they would get their share of those payments as quarterly distributions. So they get passive income every quarter coming out of it from the fund. So like I said, it's like a fixed income investment. You get passive income, but because it's not pegged to interest rates and it doesn't have the volatility that typical like stock market and stuff have, because incomes are stable over time. So we feel like this investment will provide recession hedging benefits and also tax deferral benefits, because the income share payment is not amortized like a loan payment, where the profit is earned once you recoup the initial investment in an income share agreement. So you can defer taxes on income share agreement as an investor for a few years as well. So there's a lot of cool features even for the investor that I think really helps diversify their investment portfolio even more. And hopefully the goal is that just like we're using Netcapital, your platform, to raise capital for our business, hopefully we can figure out how to do something similar for our fund so we can open it up to non-accredited investors as well, because it really is a very cool, another way of saving for retirement. In fact, every investor can decide to take cash every quarter or to reinvest that cash back as more shares in the fund and take the income later when they retire or at some future time. So we want to kind of democratize that too, is to hopefully open it up for non-accredited investors in the future.
That's great. And then in the future, do you expect that Defynance, if you can build economies of scale, you'll get to buy back that or buy out that debt, for a discount, or are you already able to buy out that student debt at a discount, or how does that work?
Well, I mean, it's interesting, like the first customer, because we have done one transaction, so we wanted to test it out completely. So it took someone through the whole process, and that particular person came to us with, I believe it was over $60,000 in student debt, and one of the things based on their profile and based on discussions with them, we actually suggested to them to go back and see if you can renegotiate with your current lender. And they were able to do that. They were able to knock off a significant amount of that. So we were able to refinance that student loan with a much lesser debt than when they came to us when they first applied. So which benefited them. From our perspective, obviously the less it is, then mitigate some of the risk for us too, right? Because we're deploying less capital for it as well. So it kind of works out on both sides. So that's the conversation we have with our customers. Sometimes it makes sense to do it. Sometimes it really doesn't make sense. But if you're like, if a lender is getting a lump sum payment to just have it all paid off, there is a motivation for a lender to negotiate down. So I think it potentially it really could be a win-win-win for everybody, because the lender's risk is getting eliminated, our customers' debt is being reduced, so they don't have to finance as much, which means their income share payment is less, and obviously we're deploying less capital. So as far as, do we do this as a more of a part of our product structure? I don't know that yet. I don't know if we necessarily are in the debt reduction, business in that sense, but it possibly could be an opportunity down the road that we'll look at. But in the beginning, we'll kind of work with our customers to help them do that. And we will have like resources in our marketplace, like especially credit resources, who can also help them in that regard, because they specialize in, working with credit and debt consolidation and so on. So those resources can also potentially help our customers.
Very cool. Thanks. I feel like we've dug into the product a lot. Just as a friendly reminder to everyone watching, if you have any questions or want any follow-up or want us to dig deeper on anything, definitely throw questions into the Q&A feature of Zoom. But moving off of the product itself for a second, let's talk about the market. How big is the market for your products?
Yeah, so the overall student debt is now, I think, if approaching, or if not over, $1.7 trillion, right? So that's a gigantic market potential. However, we feel that in the beginning, we should focus on the higher end or the most expensive student loans first, because those are the loans that have the higher interest rates. They're going to be mostly unsubsidized. They're not going to have like the protections that the standard loans do. Like, for example, interest doesn't accumulate for standard student loans until 6 months after you graduate, right? That the government basically covers the interest portion of your payments until that happens. But with these more expensive loans, and I'm talking about what's known as like the graduate plus loans, which graduate students take out for graduate school, the parent plus loans, which parents take out for their kids' education, and the private student loans, which are not even federal loans, but from private lenders. This segment of the market is still gigantic. It's $310 billion. It's about 20% of the overall student debt market. So we want to focus on this segment of the market and address the problem for where we think where people need it most. And also, really, I think the ISA will really stand apart from these types of student loans that we're refinancing in terms of the features and benefits. So market size-wise, it's a $310 billion SAM, as they call it, the serviceable addressable market.
Great. And we have our first question from an attendee. Mona asks, is there a maximum student debt that you do not refinance? For example, if someone has 100K of student debt, can you refinance that? So is there a maximum?
Yeah, I mean, theoretically, there is no maximum, but it's a function of supply and demand. We need to create a supply of capital in our fund. So I think for the first maybe few months, we're going to focus, at least anybody can apply. We will definitely take your application and we will give you the feedback, and we will put some of them, like let's say if someone applies with a 200,000 in debt, we may ask you to hold on a little bit, give us a few months as we scale the capital in our fund to be able to come and refinance you. So in the beginning, we'll probably stick with more 5 figures, 100K or less, just so we can do more transactions and continue to create scale. But theoretically, no, there's no limit. I mean, as long as we have the capital in the fund, then we can do any amount of debt. But the income for that person also has to make sense, right? So if it's a doctor who's earning, $200,000 or $300,000, but they also have $250,000 in debt, that is something can work, right? But if it's somebody who's studied, I don't know, social work, and they have 150,000 in debt, but their income is $50,000, that may not make sense. But we can then work with them to see if we can figure out ways to renegotiate that down. Or we have, like in our resources marketplace, different types of, some of our partners are specializing in debt reduction, for example, like how do you reduce your debt, how you pay it down sooner. So we'll work with them. Like we're not going to just say, goodbye, sorry. We have a resources marketplace where we can try to connect you and to see how we can get you to become a better applicant in terms of qualifying for our program. So we'll always work with all of our, all the people that apply. But I hope I answered that question. Maybe I went a little bit on a tangent, but I hope I answered it.
It sounds like you did. Obviously, if anyone needs further clarification, definitely feel free to ask. So digging into, talk to me about the business model of Defynance. So how is the company itself making money?
Sure. So we have two types of fees that we charge, and that's how our business model operates. We have one-time fees, which we charge to our customer who applies for student loan refinancing. So that's a nominal fee that's one time that can be built into the payments as well. So it doesn't have to come out of pocket. And then we also charge a sales charge to the investor when they invest in the fund. So these are the two types of one-time fees. And then recurring fees wise, we charge a servicing fee for every payment that we process, but that's again more on the fund. The fund pays for that, and then there's a fund management fee for investors. So these are the more recurring fees that are more ongoing. As we grow and we scale, then we will constantly look at how we can improve these fees and make it as affordable as possible for everyone. So, but in the beginning, this is the structure that we're going to implement.
Sounds good. And we have another attendee question. Maybe I missed it, but where does the initial capital come from to buy out someone's loan? Once you get momentum, no problem, but how do you get your company started?
Yeah, as I mentioned a little bit earlier, but we can talk about it in more detail. We're building a two-sided platform. One side is going to be for people that need to refinance their student loans, and the second side is for investors who want to invest in student loan debt. So this means that we pay off the student loans using our ISA program through the fund that we're launching for accredited investors in the beginning. Over time, we will figure out how to make it available for non-accredited investors. That fund will provide a passive income opportunity for investors. So it's like a fixed income fund. You would get quarterly distributions coming back from the income share payments that are being made by all the customers. Every investor would get their share based on their ownership in the fund, their share of that income stream. And they would get that on a quarterly basis. They have the opportunity to either take that cash out every quarter or reinvest that cash into more shares in the fund and defer taking cash out till sometime in the future. We believe strongly that the return potential based on extensive modeling we've been doing is going to be in the 7 to 10% range, annualized geometric returns for investors, and with tax deferral benefits, meaning that because the ISA is not amortized like a loan, the taxes can be deferred until the initial investment is recouped in each ISA. So that's how we are going to generate capital. Is we're going to use a investment fund that will be focused exclusively on doing the transactions.
Sounds good.
Again, if there's more clarification, I can provide it, but that's sort of how the fund would operate.
Yeah, no, that makes a lot of sense. And obviously, yes, I agree. If anyone has additional follow-ups, please feel free to include them. So talking about what's the progress been so far, we've kind of hinted at it throughout the interview, but where are you guys at and what are the next major milestones you're working towards?
Yeah, as I mentioned, we've already built our entire the process and the income sharing contract, the algorithm, so we can price income share agreements, and an online platform now, the MVP of it. And for those people that maybe don't understand the jargon of an MVP, it's not most valuable person, it's actually minimally viable product. So it's kind of the first product you build for as cost effectively as possible before you then improve it based on customer feedback. So we're kind of in that phase right now. We've kind of built a product, but we're going to be improving it over the next year. And that's some of the capital that we're raising is going to go towards that, of course. We already have over 75 applications. We haven't really done any serious marketing, but it's more people finding us on Google. Some of our SEO has been working. We've been blogging for a couple of years now, social media, et cetera. So that's how our applications are coming in, as well as from referrals, et cetera. And then now we have over 40 users in our platform, right, that I mentioned. And we just launched our fund. We have initial commitments already from some investors, and we're going to be adding to that. So the next milestone is we want to raise about $5 to $10 million for the fund. So we can do about 150 to 200 or maybe more deals. Of course, we're not going to stop. That part of the raise is never going to stop. We're going to keep raising capital for the fund. But the initial target is that 5 to 10 million from accredited investors. But really, we're going to target impact investors because we feel like they'd be very good early adopters. And then as we go further from there, like let's say a year or so down the road, when we've done about 150, 200 deals, then we have that initial data set and track record to then take it, take our story and our proposition out to institutional investors. So, the pension funds and others that are looking for these types of investment opportunities to then raise much bigger capital, the 5, 10, $20 million checks to really start scaling this up and so on. So that's how we're going to scale this thing. But to me, the biggest milestone is raising the capital in the fund and also bringing as many users as we can into our platform. So we're targeting hopefully about 500 users or more by the end of the year.
And when you say 40 users, does that mean there's 40 income share agreements out, or is that 40 people kind of working through your process?
Yeah, so some of the applications came in before we started the platform. When I say 40 users, I mean people that have created an account into our online platform. They've either applied for the income share agreement or they're checking out our marketplace of resources for like career support and those types of things. So that's what I mean by users. So our solution has in some ways multiple customers. So we have the person who's going to refinance their student loans. We're going to have investors who invest in our fund, but also users who simply may just use our marketplace and one person can do all three things. They can invest in the fund, apply for ISA, and use the marketplace too. So it's going to be a combination.
Makes sense. We have another investor question.
Sure.
So what kind of information is provided to investors relative to income tax reporting? And what is the form of the company? Is it a partnership, corporation?
Yeah, the fund is an independent entity. It is a Delaware LLC, the fund itself. Defynance as a company is a Delaware C Corp. So those are the different, but the fund is not owned by Defynance. It is an independent entity that will be owned by the investors that invest in the fund. Defynance will have a management agreement with the fund to manage the operations of the fund and everything you've talked about that we're doing. So that was one part of the question. What was the other part of the question?
The question was, what kind of information is provided to investors?
Yeah, so we have a whole pitch deck that goes over how the fund operates and how we've done all types of back testing and different things. So that can be shared with investors. In the beginning, we're not going to onboard investors directly into the platform. We're going to have more individual conversations with investors because it's early. We want to make sure they fully understand what this investment is all about. And there'll be a term sheet. There'll be an operating agreement for how the LLC operates. All that will be shared with investors as well. And then they'll be able to make their decision. And then once they've made their decision, then we will give them an account into our platform where they can actually see the progress of the fund, manage their investments, decide if they want to take cash, read, like the different functions from a dashboard perspective in terms of how they want to deal with the fund in the future.
Makes sense. And so another question from the crowd. Cool. If someone is currently in school as a returning student and is currently working part-time, can he still apply for Defynance?
As long as the minimum income requirement right now is $30,000. So if your income is $30,000, you can apply. In some cases, based on our risk assessment, we may advise you to wait till you graduate. But in other cases, we may be able to fund you in school. It also, I think part of it is going to factor into what type of degree they're pursuing as well. So I can't give you a definitive answer because that's going to be more a deal by deal basis. But the minimum requirement is $30,000 in income. So that needs to be there to apply.
Good to know. We're coming towards the end of our time. So if anyone has additional questions, definitely feel free to put them in now. Talk to us a little bit about how COVID-19 has affected, your plans and the company so far.
Yeah, I mean, obviously, well wishes to everybody that's, suffering through COVID and everybody that's, lost their lives, their families. But I think in many ways, COVID and what's happened here helps us tell our story better because even for an ISA refinancing customer, there's even like lawyers and doctors, people that never thought or at least felt maybe that their profession is recession proof. But now they're seeing an impact, on their personal lives in terms of jobs, income, etc. So I think the protections, the downside protection, or the sort of the safety net that the ISA provides is very relevant, and I think it will be more relevant to a lot more people if they kind of, in terms of what's happening with COVID and how we communicate that to people. Even for fund investors, right? I mean, recession is having an impact on investment portfolios all over the place. So I think this type of an investment that we're creating, basically a new asset class that is based on someone's earning potential, which tends to be very stable over time, has a lot of recession hedging properties. I think investors will benefit from considering our fund. And I think the marketplace is the one thing that we were working on or planning to work on, like probably this time of the year, to start working on it. But because of COVID, we just accelerated the development of that. And I think that's another very important thing, that it's open for everybody. Anybody can use it. We're not charging anything. We may figure out monetization strategies down the road, but for right now, especially in COVID, it's available for everyone. So I definitely encourage people to sign up for our platform, even if you don't need an ISA, even if you don't have student debt. I think everybody can use resources to help them, navigate their career. And the one thing that I do want to emphasize here is, yes, sure, we'll have the Indeeds and Credit Karmas and, Korn Ferry and some of these bigger names everybody knows, but we're also going to feature very cool companies that are maybe startups, maybe not as far advanced or well known as others, but have really very interesting approaches to dealing with, career, future of work, wellness, and all kinds of things that we feel are relevant for our marketplace. So you're going to find companies that you're probably not going to easily find out there, kind of searching on your own. So definitely come and check that out.
Yeah, that's great. We got one more question coming in. If someone makes less than 30K per year, he should not apply now. Do you offer any other options for these individuals?
Yeah, absolutely. I mean, sign up for the platform. We can work with you on the resources marketplace. There's going to be recruiters, job boards, career counselors. So you can kind of talk to them, figure out how you can advance your career, upskill resources. Maybe the job you're doing, the industry you're in, maybe has a certain ceiling or cap in terms of how much money you can make, but you can get upskilled in other areas and change your career. So that's why we've kind of built this platform that's it's comprehensive, and we want to work with as many people as possible. And if the ISA is not an option today, that doesn't mean it can't be an option tomorrow, but there should be some strategic plan to get there. And that's what the resources marketplace does. And we're always here to make personal connections with vendors. We're building partnerships with different resources in the marketplace as well. So yeah, come talk to us, check out our platform, give us feedback. But the other important thing for us, like especially on the marketplace side, we need a lot of feedback. We want to know what people like, what they don't like, what type of resources we should curate and find and put on there. So in the early days of any company, right, customer feedback is even more crucial. It's always crucial, but it's even more crucial in the early days when you're kind of figuring out what your product really looks like. So I would encourage anybody, even if your income is under 30,000, to come check out our marketplace.
Right. Yeah. So it sounds like, just to reiterate, it sounds like anyone who has any kind of student debt can potentially get value from Defynance, not only from the ISAs, but from all the other resources you put together.
Yeah, I would go further and say it's not even about student debt. It's about even your career or optimizing your income. If you're interested in improving your income, then yeah, come check out our marketplace and talk to us. Give us that feedback. I think hopefully we'll be able to really help you, and it's going to grow as well, right? I'm not telling you that it's a perfect marketplace today, but that's why I'm encouraging people to come and apply and give us feedback, because we're going to listen, and that's one of the things that as a startup we're very accustomed to doing, is to listening and learning and making what we're doing better.
That's great. And so, last big question from my end is, as you look out into the future, I know it's going to be hard to predict, but for investors, what do you see as kind of the long-term future of the company? What are potential exit events, or how do if you're someone's here thinking about investing into finance, why should they invest?
Yeah, so let's start with the investment in the company itself, Defynance, which is the campaign we have going on in Netcapital today. So we definitely want to pay dividends once we become profitable. We forecast about a 3-year profitability threshold, and again, obviously, I'm not going to guarantee anything, but that's sort of what we're forecasting. So we'll pay dividend to investors. We feel like as we go further in the process, we're doing something very innovative. As far as we know, nobody else is doing income share agreements for refinancing student loans. We could become an acquisition target for various other players in the marketplace, in the student debt space. So, for example, that could be a great opportunity for investors to exit out. If we exit out as a company, hopefully someone pays us hundreds of millions of dollars to buy us out, and we can all profit from that. The next stage, like we're at the seed stage in terms of where we are in our development. The next stage is called Series A. And in Series A, you have stable income, you have traction, you validated your product. So companies like ours, fintech companies, are typically valued at 50 million or more in a Series A round. So if you're investing today, our pre-money valuation is 6 million. You could see an 8x return or more as an investor if you're exiting out at that time potentially. And really one of the really cool things for us is being on Netcapital is the secondary market you guys have, because it gives the crowdfunding investor the opportunity to take control of their own investment and list their shares for sale. Or if you want to buy more shares, hopefully people want to buy more shares in our company, they can even request to buy shares. So I think that's another exit opportunity that you don't even necessarily have to wait for us to exit out in the future or Series A round, etc. You can even list your shares for sale in Netcapital's secondary market. So that was one of the big decision factors for us to use your platform, besides the great folks that are here at Netcapital. And I really mean that. Everybody's been so awesome in terms of working with. So shout out to Lily, Vlad, and Jaden, and of course now Rob. So all the people that we've been working with. So I think these are the different ways we exit out. And on the fund side, if you're investing in our fund as an accredited investor, 7 to 10% is what we're forecasting for a return, but that's an annualized geometric return with quarterly distributions. And we certainly expect low volatility there as well. So I hope, that addresses the various different exit opportunities. But and if we're wrapping up, I do have a couple more minutes, but if we need to wrap up now, do want to mention that please ask questions on the campaign page itself. A couple of people have already asked questions, and I've answered them. So always willing to engage and talk and answer questions. And yeah, please invest in our campaign, support us. This is a huge problem for millions and millions of people, and I think we can all come together to solve it together.
I appreciate that, Farrukh. Yeah, it looks like we've gotten through all the questions. It's been a great 50 minutes or so. If anyone can sneak in a last-minute question, feel free to do it now. But otherwise, if other questions come up after you're done here and you realize you need to ask, just like Farrukh said, go to the Netcapital page. It's currently in the chat, and it'll be in the link to this video or in the description of this video, wherever we post it. You can ask questions there. You can invest via the Netcapital platform, and you can follow Defynance, from now for as long as you'd like. So, with that, Farrukh, any last thoughts you want to share before we wrap up?
Just some quick shout outs to, of course, all the team: Sean, Akash, Zen, Michael, Shanice, and as well as Ibrahim and Anas. And also shout out to 444 Marketing Agency that's been working with us very closely, NLVS Tampa, which is the firm that's helped us put together our crowdfunding video. Please check out our crowdfunding video. I think it's gorgeous, looks great, tells the real story about what's going on, and share that video. It's also available on YouTube. And of course, ATDC, Embark Collective, and We Work Labs, and everybody else that supported us, advisors and so on. Really appreciate all of your help. And and Netcapital, lastly, you guys have done a great job as well. And thank you, everyone. Look forward to engaging with everybody, and we'll do as much as possible to put on some more information sessions in the next few weeks.
That's great. Well, we appreciate it. There was one last-minute question, so why don't we sneak it in here?
Yeah, absolutely.
And then we can wrap up. So, is there any reason why you can't handle other loan types like credit cards, things like that, besides student loan?
Yeah, no, absolutely. That's part of the expansion strategy. So, like you said, credit card debt consolidation is one area. We also feel like as an alternative to personal loans, the ISA structure could work very well there. It could also work for like companies with more stable revenue streams, like for companies as well. So yeah, we certainly want to expand the offering. But when you're starting out, you need to kind of focus on one area and really figure out and think of it as a giant proof of concept with student debt first, and then we expanded it into other areas. So yeah, hopefully that's coming. But when that comes, that means we've done great here. So that means we're able to grow into other areas.
That's great. Well, Farrukh, we appreciate the shout outs. We appreciate you taking the time to really dig in and explain to us, the ins and outs of Defynance. It looks like a couple of attendees have already made investments. So
Awesome.
if anyone feels so inclined, please feel free to invest in Defynance's offering on Netcapital. And if any additional questions come up, please post it on the discussion board. Thanks to everyone watching live, and thanks to everyone watching it via recording. I hope everyone stays safe and healthy out there.
Yeah, absolutely, Rob. Thank you so much. It was a pleasure doing this with you. And yeah, look forward to a successful raise.
Yeah, we're looking forward to it as well. All right. Thanks, everybody. Take care.
Bye-bye.